Hello, this is Larry McManus with Team Wealth Investments, and welcome to our educational series on investments. We're going to talk about saving for college. Usually the first question I get from parents is, how much money do I need to save for college? And I usually turn the question right around and ask, where do you want your child to go to school? And what are you willing to spend? The answers that I get vary widely from technical school to private college. And we're not going to fund anything we'll pay for 100% of everything to get them through undergrad or graduate school. Once we understand the answers to these questions, we then can go and pull out one of the six, or a combination of one of the six most commonly used tools to save for college in the future. The first one is the 529 plans that are very popular. There's also I-bonds, the Coverdell or the old educational IRAs, gifted securities from grandparents or possibly your own company stock, UTMAs or UGMAs, and also finally the qualified distribution from a retirement plan. The 529 plans are the most popular and the ones that we usually reach for first. Each state has its own 529 plan, and there's also an independent 529 plan. These are exempt from income tax if the earnings from the plan itself is used for higher education expenses, as defined by the IRS. These are great plans, especially for savings from other people. If your grandparents or your parents or siblings want to contribute to your child's education, everyone can contribute to one place and the money grows tax-free. These are very flexible and typically are used for long-term investment horizon. We encourage people to start investing in these immediately after somebody's been born, but clearly they can be used up to and through high school. The next tool we reach for is typically I-bonds. I-bonds are issued by the U.S. Treasury. They're inflation-based bonds, and their interest rate changes every 6 months. We use these bonds predominantly because they can be used for higher education, or if the student gets a scholarship or doesn't go on to college, they can remain in the parent's name and be part of their overall portfolio. The interest rate on I-bond changes every 6 months, and for the current rates, go to treasurydirect.gov. Next is Coverdell, or the old educational IRAs. These aren't used too much because they're limited in the amount of money that can be put in them annually. That's limited to $2,000 a year. That has not gone up with inflation at all over the last 15 years. And there's also a adjusted gross income limit that applies to these also. So this account would need to be supplemented with an additional tool that we've talked about already. Next would be gifted securities. So grandparents may have had highly appreciated stock that they may want to donate to your child, who then can sell at a lower tax rate than the grandparent. Or you may have employee stock that you've accumulated over time that you could gift over to your child, and again, they could sell that and use the proceeds for school, and they're going to be taxed at a lower tax rate. Next up is the UTMA or the UGMA, depending on what state you live in, will determine the nomenclature. But these are accounts that can be used before college to pay for private school or summer camp. So if you want to set up an account that you can contribute to that can grow over time to pay for private schooling, UTMAs or UGMAs are a good way to go. The one caution we always give people is that by state law, whether it's 18 or 21, all of the money in that account then becomes your child's account. So we warn people that this can become the red Corvette fund at 18 or 21. Finally, the last tool is the qualified distribution for retirement plans. This is typically comes from an IRA, whether it be a regular IRA or a Roth IRA. And as you pull out the amount of money you need for qualified education expenses, you'll only pay the income tax that's due on that money. You do not pay the 10% penalty that normally goes associated with a pre-59.5 distribution. This is not the optimal investment vehicle to be pulling from because it's pulling away from your money in the future at retirement. And as we also tell clients that there are no scholarships for retirement, but they do give out scholarships for college. If you have any other questions, feel free to contact us at either the email or the phone numbers below on the contact sheet. Thank you.